What is going on, Marathon Trading? It is your boy here with you today, and we're talking about risk loss. Why most traders burn out, why most traders aren't there, why there's such an influx of new traders yearly. So we're going to start out by why you are losing money. The majority of day traders quit relatively quickly. More than 75% of all day traders quit within 2 years. If you are in this game longer than 2 years, you are in the top 25% already. Regardless if you're winning or losing, you are the 25%, the quarter that is still there. And poor performers are more likely to quit. These are the people, the poor performers are the ones that are burning out. These are the ones that are just dropping out of the market because they can't handle it. They're not learning. They're not risking their money. Or they're not using risk management. This was by a UC Berkeley study on Taiwan traders, I believe. Regardless, it applies across the board, guys. So how much should you be risking? These are portfolio sizes over here. These are the percents you are willing to risk. So the dollar risking equals the percent divided by 100 times your portfolio size. Pretty easy. Just thought I'd leave it there for whoever. So if you're trading with $1,000 and you are just starting out, you should be in this 0.5 range, only risking $5 per trade. If you're at 100,000, you should still be over here if you are just starting out. Risk management is going to keep you in the game longer, right? You're going to have a lot more trades using $5 per trade with $1,000 account size. Then 20, you're going to have 4 times as much. That's going to be 4 times longer, right? If you stay consistent with the same amount of trades. So this green zone is your starting out. The 2% over here is when you know what you're doing. This is the veteran side, right? Veteran mode. And a lot of people start out here. A lot of people start out at 50% they're willing to risk because they think they have a good idea or they don't know what they're doing. Trading options, not knowing state of decay, any of these types of things. If you trade something, you go through an earnings call that you didn't even know. There's so many different factors in it, but starting out, you can make a mistake. A $5 mistake is not going to kill you on a $1,000 portfolio size. So how much should you be risking? How many shares should you be buying? We're going to do a real example after this, but the dollar amount risk divided by your strike price minus your stop loss. Of course, it's the opposite if you're shorting a stock. This is for going long. So if you're just starting out and you only have $5, that $5 per trade goes right here. Don't get antsy. Don't start bumping up into the $20, $100, $200 ranges because you think you have a good idea. You know what you're doing. Stay out of that. You're going to be in the game much longer if you follow this. You set up your rules as a trader, guys. You stick with them. So here is a trade we're going to be talking about today, BYND. We're checking the 15-minute chart for resistance first, and it's clean. This was on 4/21/2020 if you want to go back and check it yourself and look through it. So off the bat, looking back, no resistance, no support, blah, blah, blah. I mean, it's clean. It clearly broke this little line right here of, 83.50, 83.80? Right here, it smashed through it, right? There's nothing behind this. Nothing. That's a huge thing. I mean, if it's choppy up and down, it's a lot harder. But if you trade differently, this could be any sort of way. But we're just going to be looking at this today. So right here, consolidation right around that 88.34 mark. High's already been broken up here. So we've got room to run. We've got definite room to run. Opening bell, igniting volume here. Not that much volume. Igniting volume at the opening bell. So how much should I be risking off of this slide, right? $90.30. And it's got room to go up to $93 here easily. So I'm about to buy in at 90.30. I see that it's breaking this level of support consolidation. And I'm going to have my stop loss down here at the bottom of this level at 87.03 right here. So I'm going to let it run, right? Let's just say hypothetically I've got a $50 amount that I'm willing to risk per trade. So I'm going to take that, I'm going to divide it by $90.30, my enter price, my strike price, and I'm going to subtract that stop loss off of it. So I can have 15.291 shares. Here's the catch. This means I can trade 15 shares beyond. Always round down. If you do this long term and you're always rounding up, that means your losses are going to be a little bit bigger, a little bit bigger, a little bit bigger, until you blew up way quicker than you thought you ever would, right? You want to stay in the game for this when you're learning. This is just like a college career, college degree. You can't just start out after the first month of your engineering degree, start out designing a bridge, designing an engine. You take years building up that foundation. Exact same principle. And here were my filled orders, just to show you guys that I walk the walk. I mean, these are actual trades I will be showing you guys that I have taken. And then right here, look, $92, I got out. I had my target set at this before that 93.06. If I broke that 93.06, I might buy back in. But I was taking profits at this level. So that is it. Thank you guys so much for watching. Be sure to check out some of the other videos, like and subscribe. Until next time.